Hey everybody, welcome to the morning market briefing. It is Monday, September 12th, 2022. Hope you're doing well out there. Quick programming note while we're thinking about it. No calls next week. So next Monday, Tuesday, Wednesday, Thursday, and Friday, no calls. Ben's having a little shindig and Tom and I are attending. So we will be out, no calls next week. Office is still open, still grinding, but no calls. So just a reminder, I'll look forward to seeing everybody log in because I get those emails when people log into the calls, and you guys will probably forget, but no calls next week. Don't say we didn't tell you. Jumping into this week as we look at futures right now, pretty green. Dow futures up 20 basis points, S&P up 42, NASDAQ up 42, gold's up, silver's up, oil up 0.69%. Everybody kind of looking ahead to the CPI release that is coming tomorrow. The headline expectation is for 8%, which would be a downgrade from 8.5%. Last time we got a reading. Core inflation expected to tick up from 5.9 to 6.1. Guys, as we're looking at this number, what gives you positivity and what are areas of concern?
I think on the positive side, you do have gas prices that came down, airfares and used car prices came down in the month of August. Hotel prices came down just a little bit as people pulled back on some of that leisure spending, but that stuff's coming back. We've already seen a little bit of a tick up here in the early parts of September, both seasonally and then just also macro, because what we found is that a lot of this starts to act on a lag. So when people were going crazy on buying plane tickets in March and April, for example, things were pretty strong in May and June in terms of people actually traveling, and then it pulled back a little bit in August. So I would expect that to start to come back as people have felt more confident. You can see that in the consumer confidence readings in the last couple of weeks, which probably isn't good for inflation in October and November, but for now will probably lead to a relatively lower reading on CPI this month.
Sorry, go ahead.
Yeah, I was going to say, Tom, do you think the expectations are in line with what you're expecting?
Yeah, I think so. I think that what we're going to continue to see is a convergence between the core and the headline. I think we're going to just continue to see some of the stuff come down. But to Ben's point, my worry is that everybody felt pretty awesome about the economy in June, July. And so I think that we're going to see a big step down in the overall number and a little bit of a step up in the core number this month. But I kind of expect next month to be more flat. I think that we'll probably see a little bit of that bleed through. And if anything, we might get a flat overall number, but maybe a little bit of another tick up in core, which I think it just kind of cause this pendulum we've seen, which is that if we get a low number tomorrow, we're going to see a lot of euphoria, right? We're going to see tech stocks rally. We're going to see bonds drop significantly. And I think that sets us up for another situation like we've had the last couple of weeks where, it is either flat or slightly up following. And then we're going to be in a situation where people are running away from bonds, running away from tech stocks. We've just seen this like 45-day swing this year where it's just like game on, game off, game on, game off. And we're starting to see a little bit of a game on, I feel like, the last couple of days.
On the personal finance side, I would just say, yeah, be careful on pricing on where you're buying things and maybe not going with the herd so much. Used car prices have definitely come down. It's better to buy now than it was before. But just be mindful of that. I feel like I have not heard nearly as many people talking about, I would never buy a car right now. I think that a lot more people are becoming a little bit more accustomed to buying a piece of furniture, buying a car, buying a new TV. And I think that's good. We want the economy to go. But just be careful about the price that you're paying for some of these things.
Yeah, it's relatively interesting, I think, too, even from an anecdotal standpoint on the car side. I was noticing this week, just driving down Parrot Parkway, the lots are pretty full with vehicles, which was not necessarily the case 3, 4, 5 months ago. So there's definitely some inventory there, and it will be interesting to see if we start to see some jostling on pricing there. My guess on the CPI relative to the headline expectation, the core expectation, I think we're going to come in the high 7s on headline. I think core is going to be closer to 6.5.
Yeah,
that's kind of my guess, which would speak to your point, Tom, in terms of that convergence. But we'll kind of see what happens. We'll see how the market reacts. We've had a nice bit of relief on the equity side the last couple of days in terms of trading. Ben, you think that's justified, or do you think it's just maybe even just a read through on sentiment.
I think a lot of it's a read through on sentiment. I think that the economy has picked up in terms of, you're looking at retail sales, that's picked up. If you look at credit card data over the last couple, 3 weeks. What I would note on that though is a part of the market rally is also driven by, we had 6 down days in a row, and then we had 4 up days in a row. And so I think it's worth keeping that in context and understanding where we were coming into that. But secondly, the US dollar has actually weakened significantly over the last 5 days, 2.5%, which isn't a lot in context of the big decline, big rally that the dollar has had. But I think what underlines that is the sense that the CPI number will come in lower and that the Fed will not be as aggressive. And I think that ultimately is the narrative that's led to some of this rally. So like, I agree with you, Andrew. I don't think the CPI will be as hot, but I don't think that's going to stop the Fed from continuing to keep its foot on the pedal and continuing to tighten this economy. I don't know, Tom, what your thoughts are on that.
Yeah, I think that they're going as hard as they can right now, and I don't see any indication that they're going to change unless this thing comes in with a 6 handle. There really is nothing in there that I think is going to change their tune. Maybe look at futures right now. We're looking at 6 more hikes with 3 of them coming next week. I would take the over, honestly.
Yeah, I mean, I think that's the thing. You have to have kind of the prolonged context. We're sitting here looking at relative improvement if we can go from a headline number of 8.5% to 8%. Let's pretend it comes in at 7 relative to what the Fed's stated objective is and how they quantify that. I mean, we're still so far off.
Yeah, we're not even halfway there.
Yeah, so I continue to think the Fed's going to have to stay on the gas, continue to raise rates. I'm a bit surprised, kind of to your point, Ben, that the market is anticipating more dovish Fed action, especially in light of, the Wall Street Journal report last week kind of indicating, hey, maybe it's going to be 75 basis points.
It's weird because you have the market data and you have the path of inflation, which is down, and then you have the market interpretation of that. And then you have the Fed governors coming out and pushing against that every single time.
Yeah.
But the problem is talk is cheap. And at the end of the day,
and nothing else is.
And the market is that's a good one. And the market is going to respond to the actual data. And the market has so little confidence in the Federal Reserve to actually predict what's going to happen. They're basically calling the Fed's bluff and saying the Fed doesn't know what's actually going on. We know what's going on. And that is inflation is coming down and the Fed's going to get off this tightening train.
Yeah, and that's the thing. I have a hard time disagreeing with the market sentiment that the Fed doesn't know what they're doing. I think where the rubber hits the road for me is I think the Fed likes to do what it has been doing for as long as possible. And that's where, do I think they're totally right to continue to give us these triple hikes over and over and over? Not necessarily. I think it's right now. I continue to think, and I think I've said it multiple times on the call, I continue to think they are going to do that one too many times. I don't think it stopped.
That's what history says.
I mean, you could also argue that we wouldn't be in this mess if they had started raising rates when they should have, so it's like they should have raised rates. They didn't. Now they're raising rates. Maybe they shouldn't be, it's just they're going to do what they're going to do sort of agnostically to what the reality is. And I think that's how we got here. And I think that's why we're going this direction.
Company noise going on. There's not a whole lot today, but Union Pacific has been upgraded by Bank of America despite concerns over union negotiations. Kind of an interesting development there. And then we have Apple iPhone pre-orders showing pretty good interest and demand, which I think is a positive for the overall market and a read through on just the consumer, I guess.
Yeah, lead times in China are actually pretty long. And I think that's less a supply issue now than a demand issue, which is good news. It should help Apple's quarter this time around, and then also bode well for the guidance for next quarter. This is Apple's 4th fiscal quarter that'll wrap up in September. On Union Pacific, Bank of America is looking at these labor negotiations as a buying opportunity, saying that there's some weakness priced into the stocks and that market fluidity is actually improving significantly. And I would agree with that based on Union Pacific's comments from its conference last week. So I definitely have some sympathy for these upgrades, and I don't think Bank of America is wrong on it. I am watching the union negotiations pretty strongly, but they've already made agreements with 10 of 12. So they need to get these last two union deals done, but they have until Friday to make that happen.
The week ahead, we've got Starbucks with an investor day tomorrow. Ben, what are you anticipating to hear from them? Are they going to just try to distance themselves from China as much as possible?
I think they're going to shift from, I think they're going to use the Disney playbook. And the Disney playbook now is higher pricing and really what they call the yield management. And yield management is essentially extracting as much revenue per customer as possible. And I think that's what Starbucks is going to do. And I think they're going to focus on North America. I think it's going to be extremely costly. I think they're going to be doing a lot of renovations of a lot of North American Starbucks stores, but I think that takes some of the focus off China. It takes the onus off China, which I'm a fan of. And I think that it means a lot of expenses in the near term, which is one of the reasons a lot of brokerages have failed to recommend Starbucks as buys over the last few weeks. Having said that, they have a new CEO that's come in. He's drinking the Howard Schultz Kool-Aid. And I think that it's going to be a very expensive year for Starbucks, but I think that one that ultimately is already priced into the stock. And I wouldn't be surprised to see the stock rally. I think it's a fairly binary event. I don't really have an edge on it, so I'm not getting aggressive at that by any means, but I wouldn't be surprised to see, especially in this market environment, the stock to move higher on the news.
We also have the University of Michigan Consumer Sentiment Index. I guess this is kind of their revision, or actually the preliminary data, coming out on Friday. The expectation is for a reading of 60. The previous reading was 58.2. They released this data basically twice a month. Preliminary data tends to be what the market reacts to a little bit more. We'll be interested to see that data. I mean, as we try to kind of trend in the right direction. I mean, this was an index that was, below 50 for a little bit earlier this summer, trying to rally back up. Obviously, we've historically seen much higher numbers, closer to the 100 range, even last year tipping close to 90. So something to kind of keep an eye on. Anybody real pumped about that?
I think the inflation expectation component of that will be notable. Last time they came out in June, and I think the inflation expectation was close to 5% or something like that. And that really scared Jay Powell and resulted in a 75 basis point rate hike. This time, I do not expect that. I actually expect that inflation expectations will have declined. And I think that the ultimate consumer confidence number will be significantly higher than even the 60 estimate. So I would expect a favorable market reaction on that, because I would expect lower inflation expectations, a higher number, and ultimately that to feed through as the market looks forward to the meeting the following week, Fed meeting next week. Ultimately, they'll be trying again to say the Fed's going to turn dovish, which, as we just said, I think is probably a misplaced read, but I think is the read that the market will take from it.
Yeah, I think for context, the reading in March of 2020 was in the high 60s. So are things worse now than they were staring into the initial fears of COVID? Probably not. So I would expect, to Ben's point, for this number to rally significantly higher than that 60 number for sure.
Awesome. We're going to wrap it up there. We'll be back tomorrow morning at 8:30. We'll be here all of this week. No calls next week. Again, no calls the week of September 19th. But we'll talk to you guys tomorrow morning.